4 months ago, I made a video in which I was highly critical of Joseph's decision of selling Google to buy Amazon and for the panic he was creating among his audience. Ironically, for the past 2 weeks, after Google is already 50% up, he's saying that Google's undervalued and that he's buying. Right? So he and the media, especially CNBC, obviously didn't like the stock when it was $140 per share. Nah, they like it now when it is $230 per share. And trust me, I'm not making this video to say, oh, look at me, I'm the best, no one can do it like me. Nah, because I make much bigger mistakes than anyone else in the investing community, as you've seen throughout my videos. The point that I want to make very, very clear is to forget about the narratives. Forget about the stories. Forget about the, oh, look how beautiful this company is. Oh, everyone's talking about it. Oh, everyone wants to buy Alphabet. No, forget about it. Don't listen to them. Don't listen to the herd. Do your own due diligence. Because now, the same people that 4 months ago were saying this crazy stuff about Google, this nonsense, right now are even saying more nonsense. Oh, this is now the best company ever. I've heard even people say that they can monetize the TPUs. I mean, yeah, they could, but that's not the purpose. You want a company that can sell the best software for others for their data centers? That's already Nvidia. Like, don't come up with Google now. These narratives that we're hearing right now are just as dumb as the ones from 4 months ago. Moreover, I've been trying to communicate this message for over 9 months now, almost 10, that Google was under no circumstance going to be broken up. It's like everyone had forgotten that the United States is the synonym of capitalism. And now everyone will be, oh, Cris, there's no way you already know that. And trust me, by no means I'm a legal expert, so take this with a grain of salt. But I had this amazing teacher, Sebastien Fechot. He was teaching us business law, and we were studying the anti-monopoly case from Microsoft during the 2000s. And obviously, it's been a lot of years since this class, but it stuck with me ever since. Like, there's laws, right? There's people that actually do these laws to ensure that there's no monopolies. But come on, you and I already know that these monopolies exist. And yeah, Google was a monopoly. I knew that and I acknowledged it in this video, but they will not break it. The Congress owns a lot of Google, a lot of Microsoft. It's aligned with their best interest to not break these companies. And obviously, this was a great story to get likes. All of the videos that were talking about the US breaking out Google had amazing views, and not only views, but amazing RPMs, which is fine. At the end of the day, YouTube is to comment things, right? The real problem was the people that actually believed the story. And the goal of mainstream will always be to scare people, to give people something to talk about. That's how they make money. And the reason I'm saying all this is because I don't want you making the same mistakes that I've been doing for the past 3-4 years. Look at my return. It's been a 4-5%. I would have been better copying Buffett and buying 3 months treasury bills. Investing is super simple. We people just like to overcomplicate it. The knowledge is free. People that actually know how to invest, they do not care if they are making money off of you or they are not. Some are, some aren't, but mostly the best knowledge there is always free. And that's how I've been improving. That's why this year my return has been spectacular. I've been reading all of Warren Buffett's shareholder letters. I've found the best two investing channels of all YouTube. And finally, I've been listening to people that actually copied Warren Buffett, which has the simplest approach of all time when it comes to investing. And not only do I feel that I'm actually getting better, I'm actually seeing results with the money that I invest. And getting back to Buffett, everyone knows this Warren Buffett quote, but everyone has a different interpretation. I do not know for sure which is the intrinsic value of Google stock. A year ago, I thought it was around $225 per share, but to be honest, it doesn't matter. Because when buying Google, you get value, regardless if you're paying $80 per share or if you're paying $300 per share. You're getting value. Value meaning quality. This is kind of funny because the only people that wanted to buy Google here were the value investors, the practitioners, and actually the only big name that I remember buying Google when no one liked it was Seth Klarman. Google is still a value investment, just much riskier. The thing that people seem to not want to understand is the fact that risk is linked to valuation. Google is the same company, the same wonderful business. The reason I'm not buying more Google is the same reason I was not really eager to hear people selling Google to buy Amazon. Because Amazon at that point in time and Google at this point in time carry a much larger risk than Google 4 months ago. Because when you buy such a high quality business at such low valuation, this can be compared to a no risk investment where you only get the upside. When people say risk, they actually mean volatility. The price movements that can happen for no reason, for no business related reason. But this volatility is beautiful. Why? Because it creates opportunities. This opportunity created by the volatility, by the bad news surrounding Google, gave me the opportunity to correct my mistake of not investing in Google earlier. And now I have got a wonderful business bought much later than people that had invested in Google a long time ago because they were much smarter than me and they saw what I couldn't see in Google a long time ago. And now I've managed to have a lower buy price than them. And obviously, I wanted to buy a lot more, and that was the only mistake I've made. I didn't have much more spare money to invest. But at the end of the day, investing is minimizing doing too much. The worst things that I was doing with my portfolio when I started was getting into 20, 30 stocks, trying to study all of them, not having the time to know each one of them in a deep way. And now I'm managing a 10 position stock portfolio. These two investments are not core positions, they are basically speculation. I'm planning on selling those. But now I'm much more sure of the companies I actually want to own. I have much more insights, and I think the results are speaking for itself. I still do not know in which part of the market we are right now. For Google, I think we're right now in the public phase. I'm not at all suggesting that we're gonna get a steep discount in Google during the upcoming years or months, because I do not think it's an overhyped investment. But when it comes to the whole market situation with Oracle, with everything, I thought we've been here for a long time, but perhaps we're just in the media attention enthusiasm phase still. I do not know. For now, my priority is to keep buying Aker BP, then Evolution, and then I'll wait a little bit for Alphabet and ADM to see if I can achieve a cheaper valuation. I do not think they are expensive, I just think they are fairly valued, so it's much better to buy a wonderful company at a fair price than doing something else. But for now, I'm just trying to be patient. Hope you enjoyed this video, hope you learned something new. This is under no means an attack to Joseph Carlson's investing style. I love his style. I think that he has great picks. I just don't like the way mainstream media is affecting the behavior of retail investors. As always, hope you have a great day and I'll see you en la próxima.